NYDIG, Bitcoin's long-term compounding effects, the impact of Bitcoin's reward halvings, Grayscale, Bitcoin's quantitative tightening, and central control's quantitative easing. Reviewed by Mr. R. I can be found on Twitter at Sept_. Hello again, and thank you for joining. Of course, I'm not a financial advisor. This video is produced by myself as a way to document my own analysis of the current marketplace, reevaluating and building conviction in my positions I take in my own portfolio. I'll be covering monetary and fiscal policy, quantitative easing, Grayscale, NYDIG, thoughts, and the modern portfolio. NYDIG is a subsidiary of Stoneridge, a holding company that has led the creation of forward-thinking firms across the world of technology and finance, including a $12 billion alternative asset manager. Built on a stable foundation, NYDIG delivers Bitcoin products across industries from banking, insurance, to fintech, and nonprofits. On the other hand, Grayscale is a trust. We believe that digital currencies will revolutionize the legacy economy, political, and social systems. With that transformation comes a meaningful generational shift of how institutions and individuals approach investing. That's where Grayscale investments come in. Currently, Grayscale handles 44.1 billion AUM as of September 1st of 2021. Our focus will be on the United States monetary policy. That covers the three areas: mandates, tools, and the current status. The Federal Reserve works to promote a strong U.S. economy. Specifically, the Congress has assigned the Fed to conduct the national monetary policy to support the goals of maximizing employment, stable prices, and a moderate long-term interest rates. When prices are stable, long-term interest rates remain at a moderate level, so that the goal of the price of stability and the moderate long-term interest go together. As a result, the goals of maximizing employment and stable prices are often referred to as the dual mandates of the Federal Reserve. The Federal Reserve has several tools at their disposal: FOMC, interest rates, and the reserve requirements. Starting with the first one, the buying and selling of U.S. Treasuries through the open market. When the Federal Open Market Committee buys securities from the security dealers, the money supply will increase and reduce inflation. When the FOMC is selling securities to the security dealers, the money supply will decrease and raise interest rates. 2. The Federal Reserve Bank will set rates for other banks to pay overnight loans. This rate is called a discount rate. This will depend on the bank's credit rating. 3. The percent of a customer's deposit that must be kept on hand. The bank will lend out the investments and the other percent of the funds on deposit. These banks can also deposit funds not needed for the Federal Reserve at the District Federal Reserve Bank. The level of the bank reserves affects the short-term interest rate banks pay to borrow or lend money from each other overnight to keep their reserves at the required level set by the Federal Reserve. Affecting these interest rates, the banks will charge customers for car loans and mortgages and influence inflation. In 2021, the Fed is currently at a stance of purchasing more securities from the open market than selling, which leads to a larger supply of money in circulation. The interest rate has remained at 0.25 since May of 2020. For context, the rate was 2.5 in June of 2019. You can see it on screen now. At the moment, the Federal Reserve requirements are at zero, the lowest amount possible. QE, or quantitative easing. How does it work? Positive, negatives, long-term effects. Quantitative easing occurs when the Federal has increased the amount of purchases of securities, such as mortgages, long-term treasuries, bonds, or even public firms' corporate debt. As the Reserve buys more of these treasuries, interest rates will in turn lower, allowing securities traders and banks with more capital on hand. This capital can be deployed by FSIs to facilitate loans or other investment vehicles they participate in. With this action, the amount of liquidity in the marketplace has increased. Businesses and individuals can take these loans and use them for other types of consumption or investment. Like all medicines, QE has positive and negative side effects. The positive would be the reduction of a collapse of an economic system due to a liquidity issue where people and businesses are unable to get loans due to the rising interest rates. Negative side effects would be keeping interest rates too low. Lending and borrowing money can become too cheap for businesses, and selling bonds to the marketplace to raise capital, to spend capital for intensive investments such as building up machinery, while individuals will pursue other investments such as stock market, real estate, or even crypto to find a way to beat both the low interest rates and the erosion of the dollar's purchasing power. Grayscale has three areas that are noteworthy within the report: fragility, printing machines, safe havens. The U.S. unemployment rate on the left spiked in April 2020. The rate reached 14.8, the highest rate observed since the data was collected in 1948. The other notable event during this time was the price of oil hitting a negative price for the first time ever, shown on the right side. The amount of M2 supply normally follows a steady growth over time that's never gone negative. On February 2020, M2 was at $15.4 trillion, then peaking to $17.89 trillion on May 2020, a dramatic increase due to QE. Until today, the rate of M2 has continued to rise quickly compared to the past. Devaluing of the currency is ongoing. When overlaying unemployment on the M2 chart, it can provide an interesting insight into our past and our current state of affairs. The recessions are in the gray shaded areas. Spikes in the U.S. unemployment, of course, happen in sync, but the M2 did not follow the 1999 dot-com bust nor the 2008 housing crisis. But with the pandemic, we see a direct alignment in 2020, the M2 and unemployment. While this could be a one-off situation, it's worth pointing out the difference being that QE is being applied to the economy. With the market full of fear, the safe havens that most investors traditionally seek are fiat currency, government bonds, and gold. We'll be taking a look at each one in turn. Nearly all central banks are rapidly printing money, including the United States, but the U.S. dollar, which is the world's reserve currency, has helped support the U.S. economy. Most importantly, there are over $60 trillion of U.S.-denominated debt, which means servicing that debt drives up the demand for the dollar. A strong U.S. dollar could further destabilize global assets and cause deflationary spiral. As mentioned, the Federal Reserve is enacting aggressive policies to combat this deflationary risk. In doing so, the Fed runs the risk of overshooting their target, devaluing the dollar, and breaking faith in the monetary system. Government bonds have long been considered a safe haven, but the proliferation of negative interest rates and accelerating money printing may place these investments under stress. Real yield, which measures the nominal yield minus the rate of inflation, are now negative for the first time since 2013. Despite being viewed as a safe haven, government bonds may fail to insulate investors from the repercussions of the central bank's intervention. Gold has served as a global standard for thousands of years due to its non-corrosive properties and the physical scarcity. Stockpiles of gold are unable to reach global trading centers, causing delays in delivery. This dislocation is illustrated by the Morgan Stanley EFP, which measures the difference between gold spot and gold futures. The spreads are typically around $2, but have reached as high as $50. Over time, the addition of gold bullion futures and gold spot prices came into being as a digital and global interconnected after the 1990s. Reverting the use of heavy metals as the world's reserve currency would be to buck the trend of digitalization and technology progression. NYDIG's report, The Impact of Bitcoin's Eroding Halving, highlights of the important properties of its fixed supply in conjunction with the scheduled instruments called the halving events. Let's take a look at this. 21 million is the total amount of Bitcoin that will ever be created. This fixed supply reinforces its scarcity. The creation of new Bitcoins is reduced 50% approximately every 4 years, called halving events. The creation of new Bitcoin will be reduced to zero approximately May 2140. Unbacked fiat currencies and even precious metals like gold, which have a supply that grows over time, described as exponential growth, for example 2% per year, being uncapped. Parties such as governments or mining companies for gold can influence the circulating supply by adding more or reducing output. The chart here we see the creation of new Bitcoin falling in alignment with each halving event on an almost predictable schedule. When a miner creates a new valid block to be added to the blockchain, the initial reward was 50 Bitcoins. Price discovery did not occur until 2010. We have divided Bitcoin's history into eras and defined them by block rewards. Thus we call the first period of Bitcoin's existence the 50 Bitcoin era. After the first halving event on November 28th of 2011, this reward was reduced by half to 25 Bitcoins per block and thus ushered in the 25 Bitcoin era. Bitcoins have been in the 6.25 Bitcoin era since the most recent halving event on May 11th of 2020. Bitcoin's fourth halving is expected to come in May of 2024. These errors, along with Bitcoin's price, have a planned reduction of Bitcoin's reward, leading to the price and having an increasing pattern over time. When considering any asset class or investment, the compound equation is needed to be understood. The report by NYDIG covers a 5-year window and 13 different assets and measures the annualized return for each of these in the following chart. Yes, Bitcoin has historically exhibited a high annualized return. Looking at the worst case scenario return, 28.8%. Even if the investor had bought at the cyclical or local tops, but held on for 5 years, the worst would have been they have compounded their investment by 28.8%. This is the worst case scenario return. It's greater than the maximum returns of most of the asset classes and greater than 75 percentile for those others in this chart. Those and where the ability to beat Bitcoin minimums occur as their maximums, these being US equities, DM equities, EX equities, emerging market equities, commodities, oil, and gold. Notably, the geometric average percent of the annualized return of all 13 assets is 86.19, but if Bitcoin is removed from the calculation and done again, it drops down to 6.3. Historically, the Fed has aimed for a 2% inflation rate. Unfortunately, the use of QE for such a long period of time, of 2019 till today, did reduce the risk of major recession and help stabilize the economies. Regrettably, these moves by the Fed have both effects in the USA and overseas. As the USD is considered the top reserve currency in the world, debits and contracts where USD was used as a medium of exchange have lost value from the Fed's actions. The influx of cash to all the sectors, the interest rates have fallen down to 0% for Fed's interbank rate. This causes businesses, institutions, and individuals to seek new sanctuaries to allocate capital. With T-bills not being useful, as in the past, oil having gone negative at one point, and gold not holding up as well, the only asset that has sound monetary policy and scarcity would be BTC. In 2021, they have seen governments, FSIs, publicly traded businesses, and even individuals adding BTC to their balance sheets. El Salvador was the first nation to make BTC legal tender, and the nation began with a $300 million investment to build its own treasury. DBS, one of the largest banks in the SE Asia, in December of 2020 announced it will set up a digital exchange enabling institutional investors and accredited investors to tap into the integrated tokenization, trading, and custody ecosystem of digital assets. Tesla, a firm that has been in the headlines nearly every day, had made a major purchase of $1.5 billion USD worth of BTC on February of 2021, filed with the SEC. The current holdings are 42,000 Bitcoins, valued around $2.8 billion. And we have exchanges such as Coinbase, currently the only one publicly traded US stock, which has 68 million verified users across 100 countries. With NYDIG and Grayscale's points being applied to the modern portfolio, the classic 60-40 approach of 60% stocks, 40% bonds would not provide adequate returns, with nations applying QE, which normally will erode the 40% bond return. An investor should consider adding BTC to their portfolio. The amount of allocation may vary. For reference, Grayscale Investor Deck from July 2021 has backtested the outcomes from September 24, 2013 through June 30, 2021, an 8-year period, with the classic 60-40 having added various amounts of digital assets, which include BTC, varying from 1%, 3%, and 5% respectively. The two red lines on the chart are the second and third halving events, respectively, in BTC's history. The first halving event is not on screen due to it occurring before the date listed available on the chart. When looking at the third halving event, QE is in full effect. FSIs, institutions, private and public companies, and individuals began heavily investing in crypto asset markets and pulled away from the standard 60-40. By the end of the 8-year simulation, the standard 60-40 had a 81.4 total return cumulative, while adding 5% of crypto assets obtained a 211.9% total return cumulative. With the chart from before in mind, these pie charts show capital at risk with various amounts of digital assets added to the portfolio. The shocking amount of return arbitration could be found if it earned 5% added to the classic 60-40 at 61%. Of course, past performance is not an indicator of future outcomes. Based on Grayscale's numbers, 5% could be seen as the most aggressive position to take. That being said, it would be foolish to ignore the impact that this asset class can afford in the current global situation, monetary and fiscal policies nations are applying, and the personal ownership of crypto assets can offer the investor. Crypto assets should be considered a viable and essential part of the modern portfolio moving forward. Once again, thanks for following along. NYDIG and Grayscale offer outstanding information and data that can be found on their websites respectively. Also feel free to contact me on Twitter at @misstep_.